As we reported, the U.S. economy slowed down over the...
In the global equities markets, and that's what these traders are focused on. They're looking at the slide in stocks around the globe, and oil is falling as well. But I must note,
funds and other investors, the recession.
We didn't climb out of the recession.
To the recession.
Before the recession. Before
the recession.
The recession had lost.
Coming out of the recession.
It's out of the recession. Everybody.
For the recession.
The recession.
The recession and the crisis.
Pause. The American economy has gone through hundreds of recessions, from the Great Depression to the Great Recession. But what were the causes for these events to occur? Here are the most notable recessions and their causes.
Closing time. The close of an era.
The United States Great Depression, lasting from 1929 to 1939, is known as one of, if not the worst, economic downturns in the history of the industrialized world. At the peak of the Depression, just under 25% of all Americans were unemployed, industrial production fell by almost 47%, and GDP, or gross domestic product, declined by nearly 30%. So what caused the Great Depression? Well, there was no single cause for the Great Depression. However, the most notable is likely the stock market crash of 1929. During the 1920s, the US stock market underwent an incredibly large expansion. Investing in the stock market became a very popular way to make money. However, once prices began to decline, shareholders panicked. Millions of overextended shareholders immediately began to liquidate their holdings, which only further increased the rate of decline and the amount of panic in citizens throughout the country. As a result of this, stock prices fell a staggering 33% from September to November of that same year. This led to a drastic decrease in business investment, leading to a great reduction in industrial output and many lost jobs. An additional contributor to the Great Depression was the passing of the Smoot-Hawley Act. This act placed a tariff on foreign imports to the US by about 20%. In response to this, at least 25 other countries increased their own tariffs on American products. This caused global trade to plummet, and paired with the stock market crash of 1929, ultimately led the United States into a state of Great Depression. The Great Depression was not without its merits, however. Coming out of the Great Depression came with the creation of the Social Security system, unemployment insurance, and overall, just many more agencies and programs to help Americans during times of economic hardship, most of which came as a product of Franklin Roosevelt's New Deal. The United States also learned that it could no longer leave the financial sector of the country to its own devices, as it was far too likely to fail, as it did during the Great Depression.
36% food companies which export to North America were especially hard hit. In Frankfurt, West German stock prices posted.
Black Monday was a large stock market crash that happened on October 19th, 1987. After a large government trade deficit and a lower value of the American dollar, many companies' stocks started going down on October 16th. However, after the American markets opened on the 19th, there was a large decline in stocks with an eventual 22.6% decline of the Dow Jones Industrial Average. This worldwide stock crash had a large impact on American industry, but a good portion of the percent lost was regained after a few trading sessions, and less than 2 years later, America was back to where they were prior to the crash.
An absolutely great time.
The information superhighway.
In the early 1990s, with a large increase in technological companies, a bubble started where there were many large investments into new startup companies called the dot-com bubble. This led to a 400% increase in NASDAQ, the world's first electronic exchange, between 1998 and 2000. People would invest in many startup companies hoping that they would eventually become big. However, this type of new companies led to many people investing in websites with no information on them just because they ended in .com, as they believed that they could become much bigger. This led to an eventual 77% drop in NASDAQ when the bubble popped, and people lost billions of dollars. This led to many companies being unable to continue past the crash, but many of the companies that survived continued to be large mainstays, such as eBay and Amazon.
6% right now, Google about 3%, but Dell, Intel, Research Motion, and Microsoft are all to the upside. Look how strong.
Did not disappoint.
7 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16% Dow at the same time.
The 2008 crash, or the Great Recession, could have been considered one of the crashes that could have been entirely avoidable, being very much due to banks not realizing their fatal mistake and little action taken from the government before the event. But for context, Housing markets are generally a relatively secure investment that rises in value over time at a nice, quick rate. Because of this, banks love to give out mortgages. A mortgage is an agreement between one and a lender and gives the lender the right to take the property of the borrower who fails to pay principal plus interest. However, banks have limited money and they can't give out an infinite amount of mortgages. So to get the money, they group individual mortgages into larger groups to sell as bonds, a secure stock that rises at a slow rate but is guaranteed to make money to investors, almost guaranteed. This way, both banks and investors win, as banks get the capital to hand more mortgages while investors receive the stable income for their bonds. But by coming close to 2008, both banks and investors were greedy, giving loans to people that were very unqualified and clearly unable to pay back over time to make more money. And by 2008, investors realized that too many mortgages were giving out and defaulting, leading to the masses of investors pulling out as these mortgages were defaulting. But how could the economy suffer due to this? When a mortgage defaults, the house no longer belongs to the person who bought it, but to the lenders who hold the mortgage. So when a mortgage defaults, it leads to not the banks getting the house, but the investors, leaving the banks at a loss of billions that were invested into the market. With so many people jobless and banks out of billions, the American economy collapsed. And very quickly did many of the other countries so too, as America was the leading economy that everyone relied on to move money and to make money. 8.8 million jobs were lost, and $19.2 trillion in household wealth were evaporated.